Major US banks and asset managers are warning that the yen carry trade unwind is not yet finished, and I'm going to show you in today's video exactly why the conditions are now in place for a second yen unwind and a blow up like we saw in July. And at the end of the video, I'm going to highlight the major targets to look out for in the Japanese yen pairs. T. Rowe Manager, so one of the biggest asset management firms on the planet, who predicted the yen shock, sees another coming. Arif Hussain says he was early sounding the alarm on Japan's rising interest rates last year, which he described as the San Andreas fault of finance. The head of fixed income at T. Rowe Price is now warning that investors have just seen the first shift in the fault, and there is more market volatility ahead after the nation's rate hike in July helped trigger a sharp reversal of the yen carry trade. While a hawkish Bank of Japan and concern around slowing US growth helped trigger strong demand for the yen on August 5th, investors may be ignoring a deeper root of the global tumble on stocks, currencies, and bonds. This includes loads of Japanese money invested offshore that risks getting shipped back home as rates climb ever higher in the world's fourth largest economy. So the really key thing here to note is that the reason we got a yen shock before wasn't just because the yen was going up. It was the dual catalyst of a demand shock on the Japanese yen side, because as interest rates are going up in Japan, this is increasing demand for the Japanese yen as traders look to, buy yen, but primarily, people in Japan, domestic citizens, are repatriating yen. And at the same time, it's not just on the demand side with the Japanese yen. We're seeing essentially a supply shock where rate cuts are getting priced into the US. Economic data is coming in much weaker than expected, and therefore you have on the supply side an increased supply of dollars. At the same time, you have an increased demand of yen, and it's that double kind of supply and demand shock which really caused the yen to explode back in July and at the beginning of August. And you can see when that happened, the sudden abandonment of the yen carry trade, which involves selling Japan's currency to invest in higher yielding assets, helped sink the Nikkei 225 stock average by the most since 1987 and fueled a surge in the VIX index of stock market volatility. Economists briefly predicted the Federal Reserve would need to cut interest rates by 0.5 point or act between meetings, the kind of step usually reserved for a crisis. So again, what we're seeing here is it reiterated that on the demand side, yes, we're getting the Bank of Japan raising rates, and this is increasing demand for the Japanese yen and Japanese assets priced in yen. But also, we're seeing concerns around not just rate cuts in the US, but potentially even a 50 basis rate cut, which tends to be really only deployed in an emergency crisis situation, i.e. a recession. So now I'm going to show you exactly why the market conditions are again in place for a second yen carry trade unwind. And we're going to kick it off by looking at the demand side with the Bank of Japan and the Japanese yen. Picking up then with this Bloomberg headline, Ueda, the Bank of Japan chief, reiterates that the BOJ will lift rates if outlook realized. Bank of Japan Governor Kazuo Ueda reiterated Tuesday that the central bank will continue to raise interest rates if the economy and prices perform as expected by the BOJ. The comments serve to remind market players that despite the meltdown in global markets that was partly triggered by the BOJ's July rate hike, Ueda remains committed to raising borrowing costs provided the bank's forecasts materialize. So what we're seeing there is we're seeing the Bank of Japan chief Ueda reiterating the point that, look, they're going to have to continue to raise interest rates despite what happened back in July, early August, because if the data warrants it, they're going to have no choice. They're going to have to continue raising interest rates. So let's go and have a look at some of the key inflation data out of Japan to see if it warrants further rate hikes right now. And if I pull up the Japan Tokyo CPI, you can see the answer is yes. Now we're looking at the Japan Tokyo CPI and not the national CPI, because the Japanese Tokyo CPI index is a leading economic indicator for national CPI. So the Tokyo CPI should be leading in economic terms the national CPI. And what we're looking at here with Japan Tokyo CPI year on year, we're seeing the August reading coming out at 2.6, increasing from 2.2% in July. So we're actually seeing inflation jumping in Tokyo, which is leading or suggesting an upcoming increase in the national CPI. And if we pull up the Japan Tokyo core CPI year over year, we get the same story. You can see in the chart that core CPI out of Tokyo has been increasing since April. And last month in August, it came out at another high of 2.4%, not just higher than the previous reading in July, but also higher than forecast, higher than the consensus. So with the Tokyo CPI and core CPI indexes being a leading economic indicator for the national CPI, you can see that this is suggesting inflation is going to continue to increase in the near term. And also, we shouldn't be surprised to see inflation in Japan actually coming out higher than expected. So now we ask ourselves the question, well, okay, is this increase in inflation that we're probably going to start seeing now in the national inflation data out of Japan, is this going to be persistent, or is this something which is going to start to subside? And the key to answering that question is in the wages data. So if I pull up this graphic, you can see how inflation gets entrenched and how you can see if inflation is going to be persistent or not. And it all comes down to wages. And this graphic of the wage price spiral shows you that as wages increase, input costs for businesses increase. Firms raise their prices to maintain margins. This causes inflation to increase. And because inflation has increased, workers demand higher wages due to higher costs of living, and then wages increase again. So you can see once you start to get wages increasing in an economy, it makes inflation sticky and persistent because it causes an upward spiral, a wage price spiral in that economy. So if you pull up the Japan average cash earnings year over year, you can see highlighted in yellow, the country's wage growth has now topped forecasts for the second straight month, supporting a hawkish outlook on Bank of Japan monetary policy. So what we're seeing wages in Japan going up quite substantially over the last 2 months. And yes, it came down a little bit last month, but it's still a substantial jump from prior months, 3, 4, 5 months ago. And also, at the same time, we're seeing the wage data coming out hotter than expected. It's actually exceeding expectations and consensus. So all of this points to the national inflation in Japan starting to come out hot and actually being persistent because wages are going up in Japan as well, and that is supportive of persistent inflation. This is going to tie the Bank of Japan's hand. They are going to have to continue raising rates whether they want to or not. And if we pick up this Bloomberg headline, you can see the Bank of Japan agrees and understands that the risk of another yen blow-up is very real. The Bank of Japan is said to see little need to hike key rate next week. Officials keen to see how market reacts to Fed next week. Bank of Japan officials see little need to raise the benchmark rate when board members gather next week, as they're still monitoring lingering volatility in financial markets and the impact of the July hike. The BOJ is likely to keep borrowing costs unchanged at 0.25% at the September 20th conclusion of its 2-day gathering. So even though we can see that inflation is likely to start coming out at a national level, not just hot, but persistent, the Bank of Japan are very concerned about sparking another yen carry trade unwind because they understand the conditions are there. The risk is really there. However, it doesn't necessarily matter whether the BOJ hike in September or not. They're going to have to hike fairly soon. They can maybe delay it, for a few months. However, the big problem is a yen carry trade unwind can be sparked by the Federal Reserve. Morgan Stanley's Wilson says yen carry trade risk lingers for stocks, warns a big Fed rate cut could reignite the carry trade unwind. US equities are at risk from a further unwinding of yen-funded carry trades if the Federal Reserve delivers a jumbo interest rate cut this month, according to Morgan Stanley's Michael Wilson. The strategist, who until May counted among Wall Street's biggest stock bears, said that initial cut of more than 25 basis points could support the yen. This would fuel the incentive for Japanese currency traders to pull out of US assets after domestic rates moved higher, repeating the pattern that roiled global markets last month. The yen carry trade unwind may still be a risk factor behind the scenes, Wilson wrote in a note. A quick drop in US front-end rates, so in other words the 2-year yield, could cause the yen to strengthen further, thus eliciting an adverse reaction in US risk assets. So the point here is that the Federal Reserve, not the Bank of Japan, the Federal Reserve on their own, can, on the supply side, with a big rate cut or a 50 basis point cut, spark another yen carry trade unwind as money gets repatriated out of the US, out of US assets, back into Japanese assets. And this is exactly what we saw the last time we saw this shock. However, it coincided with also a rate hike out of the Bank of Japan. Now think about this. Let's say the Federal Reserve doesn't cut 50 basis points in September, and the Bank of Japan also delays raising rates in September. This is going to put, again, that kind of double rate hike out of Japan, and in this case, rate cut out of the US, into kind of October or after the election. We're going to end up in that same place where the Bank of Japan are going to have to hike and the US are going to have to cut. And there's a very good chance that when the US start cutting later on in the year, they do deliver a 50 basis point cut. Let's head back over to Bloomberg, where traders still see at least 2 jumbo Fed cuts coming soon. Bets are set for 150 basis points of cuts by the end of January. Fed swaps price in at least 1/2 point or 50 basis point reduction this year. And if I pull up this chart, you can see 110 basis points of Fed cuts are priced in for the year. So what this means is at least 150 basis point cut is expected by the end of the year. Recent activity in options linked to the secured overnight financing rate shows that traders are increasingly positioning themselves for roughly 150 basis points of cuts by the central bank's January 29 policy decision. And so check this out. To implement that amount of easing, officials would, in the absence of an intermeeting move, have to implement cuts of at least 1/2 point at 2 of the 4 scheduled gatherings through to January. So the very same drivers which caused the yen carry trade unwind and the blow up last time in July coming into August, are converging once again into September, October, or November, where the BOJ are going to have to hike rates and the Federal Reserve are going to be cutting and potentially cutting 50 basis points. Now, why are the markets betting that the Fed are going to be cutting by 50 basis points, something which is usually only seen in a crisis? So the latest NFIB survey, which is the survey for small businesses in the US, shows small business optimism has dipped in August. And if we delve into the report itself, you can see the NFIB Small Business Optimism Index fell by 2.5 points in August to 91.2, erasing all of July's gain. This is the 32nd consecutive month below the 50-year average of 98. The uncertainty index rose to 92, its highest level since October 2020. Now come and have a look at the key findings, because this really shows you what's going to happen to the labor market in the US over the back end of this year, and why markets are betting that the Federal Reserve is going to cut 50 basis points soon. The frequency of the reports of positive profit trends was a net negative 37% seasonally adjusted, 7 points worse than in July and the lowest since March 2010. 24% of owners reported inflation as their single most important problem in operating their business, down 1 point from July. The net percentage of owners expecting higher real sales volumes fell 9 points in August to a net negative 18%. Real sales volume expectations were the largest contributor to the decline in the optimism index, along with earnings trends and expected business conditions. But these two final points are what I really want to draw your attention to. A seasonally adjusted net 20% plan to raise compensation in the next 3 months, up 2 points from July. And at the same time, the net percent of owners raising average selling prices fell 2 points from July to a net 20% seasonally adjusted. So those two key findings right at the end, they are the key to understanding what's going to materialize in the labor market over the back end of this year, over the next few months, and why traders are betting that there's going to be a 50 basis point cut out of the Fed, which, as we now know, can very well spark another yen carry trade reversal, especially as the BOJ has to hike in the near future as well. So the reason this is so important is because small businesses are the backbone of the US economy, and they employ roughly 60 million people, over 60 million people. And so what we're looking at here is we're looking at small businesses in the US over the next 3 months, increasing their compensation, increasing wages, but at the same time, they're going to be lowering their prices. So we're going to get a margin squeeze. We're going to see small businesses getting squeezed over the back end of this year. This is negative for the economy. It's going to be negative for stocks, but it also means that we're likely to see a 50 basis point cut out of the Federal Reserve. Why? Because as profit margins get squeezed at small businesses, what are they going to do? They're going to fire workers. Okay, so let's jump over to the Quantitative Analytics platform, and I want to show you the downside targets for the year, the back end of this year, if we're going to, as looks likely, see a continuation of the yen carry trade unwinding. As we get a deterioration in the US labor market, the Fed have to cut 50 basis points in one of the next few meetings. And at the same time, the Bank of Japan are forced to hike interest rates again because we're seeing Tokyo inflation, which leads national inflation coming out higher than expected. And at the same time, we're seeing wages in Japan coming out higher than expected. So let's kick it off with US dollar yen. And what I've got on here is I've got the weekly levels, first and second upper bounds. We look at these in the weekly Forex forecast videos. But I also have the annual levels. And these are the levels that if you exceed this within a year, you should expect with a 70% chance the currency pair to snap back inside the range. And so by definition, if you're looking for a profit target to the downside for any long yen positions, so that would be, Aussie yen short, US dollar yen short, if you trade into these levels, these are the key profit taking levels in these markets. So you can see we do have the upper bound at the 144.87. And again, the same thing applies on the weekly, the monthly, the daily, which HedgeDash has all of these levels for, and they automatically update every day, every week, every month, etc., every year. So if we breach the 144.87 this week, this is where we become overbought intra-week, and this is where you could start to look for a sell the rip opportunity. We did look at a couple of the yen pairs, in Saturday's video. But to the downside, the key level here to take note of, to write this down, is the 128.77, because if we are heading back down in US dollar yen, the rest of this year, the 128.77 is the key level to the downside you want to be paying attention to, because any long-term yen long positions, in other words, any long-term US dollar yen short positions, once we start to trade into the 128.77 to the downside, that is where the probabilities become on your side for a good profit-taking opportunity, because then you only have a 30% chance of continuing much lower, or to look at it another way, you have roughly a 70% chance of pausing and reversing if we trade into the 128.77 annual lower bound in US dollar yen. Next is Aussie yen. Now again, notice what happened once we traded into and above the annual upper bound. We reversed back inside. And so again, to the downside, the target you should be looking for over the back end of this year in Aussie yen, the key risk on, risk off currency pair, right? Because the Aussie is the most risk on of the majors and the yen is the most risk off. So Aussie yen to the downside should actually suffer in any kind of yen unwind more than the other currency pairs. So we do have to the upper bound on an intra-week basis, 96.79. This is where if we bounce higher and we take out the 96.79, and again, with these levels, very often you bounce above it, down, up, down, making your way down to the annual level in this case. But any breach of the 96.79 is the opportunity to go short intra-week, looking for a reversal back inside the range. And to the downside, the key annual target you want to be looking for to the downside this year is the 87.59. If we trade into this, any longer term yen long positions, you should consider booking profits on over the back end of this year. Next is CAD yen. Now with crude oil suffering as well as we get a global slowdown, this should weigh on the Canadian dollar over the back end of this year. And also, if you pair that with the Japanese yen, we should see further downside in this currency pair. Any kind of breach of the 106.68 this week, although it doesn't look like we're going to get there this week, but if you do breach this, this is where you become overbought intra-week in a market we really want to be looking at shorts. Again, exactly as we do in the weekly Forex forecast video every Saturday. That would be the opportunity intra-week to look for a short. However, you can see we're very close to the lower bound. What that means is, and keep an eye out for this coming Saturday's weekly Forex forecast video, because what that means is when you trade into the lower bound, very often the following week you push up, you trade into the upper bound, and then you move down like this. The key level to the downside this year to pay attention to over the back end of this year, quantitatively with roughly a 70% chance of being correct and holding price to the downside, is the 97.35. If CAD yen trades into the 97.35 over the next couple of months, that is where you would want to be looking at booking any long-term positions to the downside in CAD yen. Next is Euro yen, breached its annual upper bound, reversed back inside as we would expect. This is where the BOJ started to intervene. And now you can see it making its way down to its second lower bound. So keep an eye out in Saturday's video for any of the yen pairs, because we'll probably get a retest of the weekly upper bound next week. It starts to work its way down like this. And the key level to the downside, the target to the downside, is the 143.11. If you're short Euro yen and you've got a bigger position, the 143.11, if it's hit this year, that is a fantastic profit-taking opportunity, which is likely, give or take a bit of volatility around these levels, because we're looking at annual levels and a daily time horizon. But give or take some volatility around these levels, that is roughly where you should expect this market to stop to the downside this year. Next is New Zealand yen, already taken out its weekly lower bound, so I don't expect this to really pull back and test its upper bound this week. But perhaps in next week's video, or rather this Saturday's weekly Forex forecast video for next week, you can look for that pullback, and we'll probably be looking at the weekly upper bound. That would be the opportunity to short next week. And to the downside, if you're looking to hold on to this, the 80.91, you could say roughly, is where you should be expecting New Zealand yen to start to settle if we trade into this level this year. And finally, we have pound yen. Now, pound yen also making its way down to the lower bound on the weekly time horizon. So this is probably a market for next week in terms of short-term trading or entries. I would be expecting it to trade into this, bounce up. I'm looking for the upper bound next week. However, you can see this should be continuing back to its prior low and also onto the downside target of the 165.21 in any continued yen carry trade unwind, where the yen, above all else, benefits. So that is it from me for today, guys. As always, I hope you enjoyed today's video, and if you did, why not consider joining us in the GMT training room each day, where I look at the best markets as well as sharing real-time setups that I'm personally looking at trading with members as part of our GMT training program. Don't forget, you can also get a 2-week free trial to the cutting-edge hedge-trading app used in today's video by heading over to www.hedge-.com. Access to the cutting-edge hedge-platform is included with every GMT membership.